Hello investors, welcome back to the channel. As a quick background, I'm a former finance professional. In this channel, we discuss topics like stocks, markets, options, investing, financial analysis, real estate, and personal finance. Please press that subscribe button below if you're interested in any of these topics. Before we get down to the discussion, let me preface it with a few points. First, everything I say is my personal opinion with backup data. You can always agree or disagree with anything I say. Second, your opinion is just as good as mine. Third, I absolutely agree that an average person would be far better off investing in the market index, just as Warren Buffett said. Lastly, investing is a game of probability. This stock is more likely to appreciate in price doesn't mean the stock price will actually go up. It simply means that the chances of the stock price going up is high. It's like poker. A player with a pair of aces has a high chance of winning, but that doesn't necessarily end up winning the pot. Now, should you pick stocks? In other words, should you even try to pick companies and buy their stocks as opposed to simply buying an index fund or ETF? This is probably the most important question when it comes to investing. And this is also essentially a question of whether you should do active versus passive investing. Active investing is where you actively pick out good companies to invest in, hoping to beat the broader market performance. Passive investing, on the other hand, is where you invest in a basket of companies like the market-based index like S&P 500 so that you can diversify your risk. The one goal of active investing is to beat the market. I'm sure most people are aware that it's very difficult to beat the market. In fact, more than 80% of professional money managers fail to beat the market. So why should we even attempt to beat the market when those who spend their lives studying the markets and finance can't even beat it? Well, there's a catch. Those 80% of the professional money managers fail to beat the market, net of their fees. That means a lot of them actually beat the market, but stripping out the fees that they're paid, most fall behind the market performance. That's why I agree with many great investors that most people are better off just putting their money into the index funds that track S&P 500. However, if you put in the effort, the reward for picking stocks is huge. And in fact, you can grow your wealth very quickly and reach that millionaire status by picking out the winners and beating the market through investing wisely. You can achieve a faster path to wealth through active investing if it's done correctly. It may require some effort and discipline, but the reward can be much better than passively investing your money. Remember, the goal of investing is not only to beat the market, but to build wealth to the point where you could retire and live off the passive income from your investments. Let me tell you up front that it is possible as a retail investor to beat the market because I've done it and many others have done it. Many have become multimillionaires by investing in the markets. I'm not saying that everyone can do this, but it is certainly doable. So many people start out in small amounts in the tens of thousands of dollar range and turn them into millions in less than 10 to 15 years. Then turn that into tens of millions in 20 to 25 years. We can all do the same, and I'll walk you through how to do that in this channel. So remember to click the subscribe button below. I have 3 reasons why a retail investor like you and me can beat the market. First, it is possible to beat the market with a small portfolio as an individual investor. Second, 2 traits are essential for an investor to win: discipline and conviction. And third, security analysis is not a rocket science. I noticed that a lot of people say they beat the market for the past year or two, and that's not exactly called beating the market. Portfolio returns that are consistently above the market for 5, 10, 20 years is called beating the market. I'm sure most of you know that a 1% difference in the 30-year annual return can make a huge difference at the end of a 30-year period due to what's called compounding. What most probably don't know is the distribution of those returns from a portfolio point of view. If you make an annual return of 15% return over the course of 30 years, that doesn't mean you need to make 15% of return every single year in practical terms. What's happening over the course of a period is that you'll make 200% returns, 100% returns, 60% returns in the early part of the 30 years, and then slowly decline to 5% annual returns, which altogether make 15% annual return over the course of 30 years. Theoretically, any investor's portfolio will look something along the lines of this over the time period. So when someone says market returns 8% on average every year, it doesn't mean it'll return 8% this year, but it has risen by 8% on average over the past 40 to 50 years. This makes sense because with a $100,000 portfolio, you'll obviously be more concentrated in positions compared to a $5 million portfolio. Therefore, you're inevitably taking more risk in a smaller portfolio. Because you can spread out $5,000 positions across 20 stocks in a $100,000 portfolio, but you can spread out $100,000 positions across 50 stocks in a $5 million portfolio. The bottom line is buying the S&P 500 ETF in a small portfolio like $100,000 doesn't make a meaningful difference if you're looking at a long-term horizon. Take Berkshire Hathaway as an example. It's a conglomerate run by Warren Buffett that is posted below annual returns. If you notice something here, the standard deviations are much larger in the earlier part of the years compared to the latter part of the years, when the portfolio simply got too big to take that much risk. In fact, the standard deviation of the returns for the first 20 years is 42% compared to 16% in the last 20 years. Warren Buffett started out with a few hundreds of thousands of dollars and grew it to more than $25 million in less than 10 years. That's about 40% a year throughout 10 years. I'm not saying we can do what he did, obviously. I'm saying that picking stocks will reward you very nicely over the long run. And we have a huge advantage because it is much easier to beat the market with a small-sized portfolio than a large portfolio, and therefore retail investors have a good chance of beating the market, given appropriate discipline and effort. In other words, it is much easier to double a portfolio of $50,000 than to double a $5 million. Warren Buffett also reiterates this point, actually. He says that size is key competitive advantage retail investors have, and he achieved the highest returns when his portfolio was tiny. He says he can guarantee 50% annual return if he had $1 million to start. So it wouldn't really make much sense for us to invest in the S&P 500 hoping for 8% annual return when our portfolio is less than $500,000. My second point is, while it is possible to beat the market as an individual investor, two traits are essential for an investor to win. They are discipline and conviction. Most people will sell at lows and buy at highs. We sell at lows because once the stock goes down, our cognitive bias kicks in, called the loss aversion bias. We put more weight on losing $100 than gaining $100, and thus losing money has more impact on us than gaining money. We also buy at highs because we tend to follow the herd, getting into the hype of trends and manias. For example, people at cocktail parties will brag about their 4x returns on Bitcoin or Tesla, which will prompt you to buy them the next day. That FOMO is a strong incentive for people to get in on the electric vehicle hype. Buying at highs and selling at lows are due to a lack of discipline, as the famous investors put it. This is also a reason why professionals say invest in what you know. If you invest in what you don't know, then you'll be tempted to sell when stocks go down because you don't know the company and you don't have as much conviction that it will recover. As an analogy, I've seen many people make New Year's resolutions as losing weight or saving more money to buy a house. Why is it so hard to do both? In fact, all of us actually know how to lose weight. Eat less and exercise more, burn more calories than you consume. It's not a rocket science, and it's simple as that. We also know how to increase the balance on our account. Spend less than what you earn, or increase your earnings through side gigs. The truth is, all of us know the answers to these large problems. The same is true for the markets. People generally know eventually stock prices of good companies will recover, like Disney or Visa. So why do most of us fail to stick to the plans? It's probably due to a lack of discipline, but more importantly, we lack discipline because we don't have convictions in our investments. If Amazon fell 30% today and stay there for the next month or two while other electric vehicle companies rose 50% in the same time period, most people would be tempted to sell their Amazon and buy those electric vehicle companies, hence the sell low, buy high phenomenon. Take this analysis shown on Wall Street Journal. The returns of a hypothetical investor who put $10,000 into an S&P 500 index fund at the start of 1980 and missed the market's 5 best days through the end of August 2020 would be 38 percentage points lower than those of someone who stayed invested in the whole period, according to Fidelity Investments analysis. This is the significance of self-discipline, the ability to weather through the tough times or carefully ride the trends. To gain self-discipline, we need a high conviction. To have a high conviction, we need to do more research and have a sufficient understanding of the assets we are buying. As long as we understand that this company will thrive with a high probability, we're more likely to hold on to these positions even in a recession. In order to beat the market as an individual investor, we need self-discipline. Self-discipline comes from a high conviction. High conviction comes from enough research and understanding of the security. Basically, the idea is security analysis leads to high conviction. High conviction leads to self-discipline. My third point is security analysis is not a rocket science. For instance, it's not hard to know e-commerce, clean tech, and electric vehicles will be future. I'm certainly not saying analyzing individual companies is as easy, but as an individual investor who lacks the resources and knowledge about a company, it's still possible to know that a company is a fundamentally strong business trading at a reasonable multiple. For instance, Fiverr is an Israeli company that allows freelancers to offer their services on its platform. It has grown sales at more than 40% annually with at least 75% gross margin. Would you expect this sort of company to continue growing in the next 5 to 10 years or go bust? And yes, it's been trending downward. But think of it this way, if Fiverr grows its sales at 40% in the first year, 40% next year, 30% after that, and 30% after that, in the next 5 years, and has a 25% net margin, it'll have $175 million in net income after 5 years. That means it'll be trading at $13 billion market capitalization in 5 years, assuming a trading multiple of 70 price to earnings ratio, compared to a $7 billion market cap right now. So it's a roughly 2x return over the 5 years. This is a great example of where a great business may currently be getting pressured in terms of the stock price, but a disciplined investor knows this business will only grow in the future and will stay invested over the course of the next 10 years. Many also argue that you can't win in the market because there are too many big money professionals and the person on the other side of the trade knows better than I do. I absolutely agree with that statement, but it's not a winner-takes-all game. The important aspect to remember is that retail investors can easily come to the same conclusion as a professional analyst who has spent thousands of hours on research. By only dealing with what we are familiar with, easy to understand companies, we don't need to use CapIQ or Bloomberg to come to a high conviction that e-commerce will only grow in the future. That's why people like Peter Lynch and Warren Buffett likes to say, invest in what you know. If, however, we were to take a stab at a company like ExxonMobil, we need to know how much of their production volumes are hedged, at what oil price are their rigs economical, how will commodity prices impact the stock performance. You need historical correlation data and regression for different time periods, and commodity futures data, and so on. Professional investors have an edge on the more complicated analysis, so it's best to stick to what we know. To summarize today's video in one sentence, it is possible to beat the market, and yes, you should pick stocks with a small-sized portfolio given a sufficient amount of discipline. If you are interested in learning more about how to pick the right stocks or do research, I'll be posting more videos on how exactly to pick the right companies, so make sure to press the subscribe button below. Thank you all for watching and see you on the next video.